Ask a mortgage expert, tips about credit score, down payment, refinancing and more. Owning a home is supposed to be the American dream. For some, however, navigating the complicated path of home mortgages can be more akin to a nightmare. Is my credit score good enough? What's a good down payment? When is the best time to refinance? Gina Nolte, a Reno-based loan officer with Closing Mark, answers 6 questions to help simplify the mortgage process for prospective homebuyers. 1. What's a good credit score? Typically, lenders look at your middle credit score. This refers to the middle number when your credit score is pulled from the 3 major credit reporting bureaus, so if you get 710, 720 and 740, your middle score will be 720. A score of 740 and higher is usually the best for any loans under $484,350, Nolte said. A 720 middle score is still considered great. A 680 middle score is about average. Even if your score is below 680, that won't automatically disqualify you from getting a mortgage. Just because someone has a bankruptcy, short sale, foreclosure, does not preclude them from financing, Nolte said. Factors that can determine what programs you could qualify for include how long ago your issue was and the nature of the default. Credit card use is another factor that can impact how many points you have toward your financial score. Avoid maxing your credit card. It's a good idea to keep your balances between 10% to 30% because you end up with fewer points the closer you get to your limit. Never pay late, as this can impact your credit, she added. It's also a good idea to keep your credit card even if you don't use it much. Never close a credit card, it will dive your score, Nolte said. Use the credit card for a small purchase every few months. 2. What will my monthly payment be? This can initially be tough to nail down because there are so many variables that can affect it. According to Nolte, your payment basically depends on several factors, including your interest rate, credit score, down payment and the loan program you are applying for, e.g. Fannie Mae, VA, USDA, etc. A lot of times, when talking to a loan officer who's fairly educated and doesn't know you, they are going to give you a range, Nolte said. If you're really serious, you can let them run your credit. And they can tell you what it should be, but it's still a guesstimate. 3. How much money should I put down? Your down payment is one of the major factors that can impact your mortgage. One traditional rule of thumb is having a loan-to-value or LTV ratio of 80% because this typically means you don't have to pay private mortgage insurance. Basically, your LTV is based on the value of your house in relation to your loan amount. As an example, if you're buying a $100,000 house and make a down payment of $20,000, you will need to borrow $80,000. This makes your LTV ratio 80% because your loan is 80% of the value of your house or the amount that you are borrowing. At the same time, you don't have to force yourself to cough up a 20% down payment. If you fall within the criteria of some programs, your interest rate goes down tremendously, Nolte said. In such cases, the savings from the interest rate reduction can be much more than what you pay monthly for private mortgage insurance. 4. Speaking of programs, which one should I use? This will depend on your personal situation, including how much money you have in the bank, what your long-term goals are, and what you plan to do with the house. Do you plan to use the house as your primary residence? Or are you an investor who wants to buy it as a rental property? There are loan programs that are good for first-time home buyers, for example, but do not allow the property to be rented out for 3 to 5 years from the date of purchase. Others, such as a USDA loan lets you rent out a property after living in it for a year, which is great if you end up being transferred for your job, for example. You will also want to compare things like interest rates and closing costs. The rules and requirements can also change from year to year, so it's important to seek help from a professional who is up to date with the various programs. You really need to sit down and look at the pros and cons of the different programs, Nolte said. 5. How soon can I refinance? Ideally, you want to wait at least 6 months and a day after you purchased your house before refinancing it, even if it sees a sudden surge in value. That's because refinancing your mortgage earlier than that means the value will be based on your original purchase price. If you try to do it before 6 months, they're going to take what you bought the house for versus the appraised amount, Nolte said. If you wait 6 months and 1 day, you can do a new appraisal and use your new equity position to help get a lower interest rate, get rid of mortgage insurance, and all sorts of other things. 6. I want to buy a house but my name is on another mortgage. One example of this scenario is when you help a relative who could not qualify on his or her own to buy a house. As a result, you end up becoming one of the borrowers on the loan. But what if your circumstances change? Perhaps you now want to move out and buy your own house because you got married. Maybe you never lived in the house to begin with and now want your own house. At the same time, the house can't be sold because the other person is still living in it. In this case, one solution is to refinance the house to have your name taken out. This can be an issue, though, if the remaining homeowner's credit or income is still not good enough to refinance the house in his or her own. Another solution is to provide proof that you were not involved in the house payments. You have to prove 12 months of payment for the house where you were not the one making the payments and that it was truly someone else, Nolte said.